Good morning, good afternoon, good evening traders, wherever you are in the world. I hope you're doing well, I hope you're safe, I hope you're healthy, I hope you've got a big smile on your face, and I hope you're catching pips as usual. Pips of Persia here with part 3 of our WYCKOFF introduction series. In today's video we will be talking about reaccumulation and redistribution, a couple of schematics for both of them, market behavior and the reasoning behind each of these schematics, how to distinguish between reaccumulation and distribution, or redistribution and accumulation, and as usual some major important points for trading WYCKOFF in general. So if you haven't watched part 1 and part 2, I would highly recommend you to do so to get a much better understanding of these schematics. Understand that these 3-part series is an introductory series to WYCKOFF, but it's still a good idea for you to watch all of them. I will make sure to link the other 2 videos down in the description below as well. So let's go ahead and jump straight into it. First things first, same as accumulation and distribution schematics, there are many different schematics for reaccumulation and redistribution, but in this video I have drawn maybe a couple of schematics and I'm going to be specifically talking about them simply because in my opinion these couple schematics are the more important ones and are the more common ones that you will actually see in the market. The other 2 schematics or 3 schematics for redistribution and reaccumulation, it is in a way just derived from these couple different schematics. So let's start off with reaccumulation. I've drawn these schematics just to kind of make it a little bit easier to see, and I've just drawn some of the more important parts. So if you have other reaccumulation schematics, you will see that on other schematics there's a little bit more going on in the general reaccumulation schematic. I haven't even put, for example, the last points of support and the test and all of these different things in this specific picture, just because I want you to get a better understanding of the core fundamental important points when it comes to reaccumulation. So what is reaccumulation in general? Previously we spoke about accumulation and distribution. Generally when the market drops, goes sideways and goes higher, that's what we expect it to be, an accumulation. Or when the market goes higher, starts to go sideways and drops, that's what we would call a distribution. Now in some scenarios you will see the market going higher, going sideways, but this will still continue to go higher. So imagine a distribution scenario, but instead of the markdown phase, we will actually end up having a markup phase, right? So that is in a way what a reaccumulation is. And since it's called reaccumulation, as you can imagine, in a way it has to happen after an accumulation phase. Now, sometimes traders get really confused because when they want to identify a reaccumulation scenario, they would get extremely busy trying to see if we did have a perfect accumulation before that. Generally speaking, if we have had a markup phase and gone sideways and continue to go higher, then that is reaccumulation in itself. For this initial markup phase to take place, we must have had some type of an accumulation earlier. As I've mentioned in the previous video, there is no need to overcomplicate these scenarios. A reaccumulation in terms of the market behavior is very similar to the accumulation. You will see it manipulate the lows, you will see it break structure to the upside, and in general that's the region, that's the range in the market that the early buyers are being taken out and the larger institutions are in a way accumulating their positions again, introducing more demand into the market. Now, a reaccumulation can very commonly be mistaken by a distribution, especially because within the first half of the reaccumulation range, it looks almost identical to the beginning stages of a distribution. This is the important point that I always mention, which is never be married to a directional bias, because if you look at a range and you say to yourself, hey, this has definitely got to be a distribution range, and later on you will see that it starts to go higher and higher, then you have lost the trade because you've stayed married to that directional bias at the very beginning, thinking to yourself that this is our preliminary supply, that would be the buyer's climax coming down to the sign of weakness followed by the UT, and then you would expect this to come lower or maybe create another UTAD before coming lower, and before you know it you will end up losing the trades because you've ignored what has happened within the second half. That's why I always mention within the WYCKOFF schematics, you have to be patient, you have to see what the market gives you, and you have to see if the information that you can read on the charts is indeed matching other confirmations as well. So looking at each and every single one of these points within a reaccumulation range, you can see how at the the very beginning, it does indeed look very much like a distribution trading range. So we have the preliminary supply that we normally have within the distribution. After that, within a distribution, you have a bias climax. You have these maybe step-by-step move to the downside, or one major move to the downside, which we mark it up as maybe the automatic reaction over here, some type of a secondary test up there, followed by the sign of weakness. Within a reaccumulation scenario, in terms of the markup, we just change that sign of weakness to shake out. So not much is different here. At the very beginning, it looks almost identical to a distribution trading range, especially oftentimes you will see this automatic reaction back up from that shakeout can be mistaken with an up thrust. This is the time that a lot of traders would actually mark this up as a UT, but again, we know that even if that is a distribution, that's not complete yet. We can't be looking at any trading scenarios until we have proof of distribution and we start to break structure to the downside. So even if you happen to identify a reaccumulation at the very beginning as a distribution, it doesn't matter. As long as you pay attention to what takes place after, you're good. In fact, a lot of the reaccumulation scenarios that we have identified at the very beginning, we thought it was a distribution. But in the journey of having patience and waiting for the proof of that distribution, we started to see that the market behavior started to change. We went from manipulating the highs and breaking structure to the downside to manipulating the lows and breaking structure to the upside. And that's more or less exactly what takes place within a reaccumulation scenario. Once we've formed this kind of first half of the reaccumulation, you can oftentimes see how we will continue to maybe create liquidity, whether it be in forms of the support and resistance lines, or even if it is lower time frame trend lines that we all know retail traders would be drawing on their charts, expecting this market to reject the trend lines and going higher, and before they know it, through this move to the downside, which we call spring within the reaccumulation, they are taken out. So I'm going to go through that one more time. At the beginning of a reaccumulation range, it does indeed look like a distribution with your preliminary supply, bias climax, sign of weakness, but we call that shakeout in a reaccumulation, and the automatic rally back up. Don't be too tough on this automatic rally back up, expecting it to always be above or below the bias climax. Allow a little bit of a range. Sometimes it forms a little bit higher, sometimes a little bit lower. The entire point of this automatic rally back up is for it to, in a way, test the previous areas of supply to have some room to go lower and perhaps manipulate the previous lows. After we get this distribution-like scenario, from there you tend to see more manipulation of the lows and a move higher than the other way around. And with the spring action, it oftentimes will be given away that you are looking at a reaccumulation rather than a distribution scenario. Yet again, don't be too invested in the schematic. What I've drawn over here is not exactly what you have to see on your charts. What I'm trying to say is within that range from the automatic rally down to that spring, sometimes the market will create random highs and lows. Oftentimes it will end up testing the previous areas of supply or demand, just creating a range, creating an area of liquidity for it to later on be manipulated through that spring. Remember that a break of structure is always necessary for any and every Wyckoff schematics to be confirmed. If you are not getting a break of structure in your desired direction, then at least at this stage, at the more beginner stages of learning about Wyckoff, you most definitely should not trade it. Wait until you have confirmation that the market has moved away from your zone of reaccumulation higher to prove that yes, indeed, that is a reaccumulation. And remember what we spoke about previously in regards to accumulation. Accumulation is a manipulation of the lows and a break of structure to the upside. And this is exactly the type of behavior that you will be able to observe within a reaccumulation range. Similar to accumulation schematic number 1 and number 2, you will sometimes be able to see a reaccumulation without that spring action. It would look something like this, where after forming these elements of distribution at the very beginning, where it kind of looks like a distribution, we don't really get that spring, which in a way manipulates the entire range to the downside. Spring, as mentioned in the previous video, is the lowest point within that accumulation that we would expect it to create before going higher. Sometimes in reaccumulation scenarios, that spring is non-existent, exactly the same as accumulation schematic number 2. These are a little bit more challenging to identify and trade, but the market behavior stays consistent even within these scenarios, where you are able to see within the range that gets created, you will tend to see manipulation of the lows and a break of structure to the upside. Sometimes people are extremely confused in terms of how do I identify the differences between a reaccumulation or a distribution. This is going to be a point that I will talk about a little bit later on, but if you want to stay safe against these uncertainties in a reaccumulation range, you can actually even wait for the market to in a way break outside of the range completely and then come back to trade it. So instead of taking into account these smaller breaks of structure to the upside within the range, you can wait, have patience until we start to break outside of the range completely. And that is where it gets confirmed that, okay, you're looking at a reaccumulation. But in live markets, it's going to be a different scenario because obviously you will tend to see smaller accumulations and distributions within the range. That makes the analysis much easier and much clearer. So let's go ahead and jump on the actual charts and have a look at a couple reaccumulation scenarios. The first one I want to speak about is this EURUSD Reaccumulation, which we already have a video about this posted as well, titled under Best Forex Strategy 2020, if you want to go ahead and watch that. I'm going to put this in replay mode and perhaps go to the hourly time frame just so we can see this a little bit easier. So let's have a look at it first from a distribution perspective, because that's exactly what we saw at the very beginning, with this looking like the preliminary supply, this being the buyer's climax all the way down to the sign of weakness and the move to the upside as your up thrust. So this, at the very beginning, you can see that it did indeed look like a perfect distribution. What happened after, however, started to little by little give it away that potentially we are not actually looking at a distribution scenario. Even if you stayed married to that directional bias and you told yourself, okay, do you know what? I'm going to take some entries, for example, at maybe this area over here. This should be a 4-hour institutional candle, if I'm not mistaken. We can have a look at that very quickly. Yeah, so let's say you told yourself at this institutional candle you were looking to take some trades. Even if you did, by the time you've seen this decline, this is where trade management would have to come into play, where you're either closing some of your positions or at least breaking even your trades. So trade management, again, is a very, very important part of this as well. So even if you are mistaken with whether you're looking at a distribution or reaccumulation, through trade management, you can manage your risk accordingly. So at the very beginning, we saw that as a distribution, but what happened after is what started to give it away, because the entire market behavior changed from manipulating the highs to taking the lows and reversing. So in a way, manipulating the lows and reversing. And it ended up forming this perfect reaccumulation scenario, this reaccumulation schematic from the buyer's climax. So that's the buyer's climax down to the shakeout. Buyer's climax down to the shakeout, following the automatic rally back up. Now, this isn't the best automatic rally. It went a little bit higher than that buyer's climax, but it's still very valid. And that's indeed what we will take into account. Following that automatic rally, we had this continuous manipulation of the previous lows and a reversal almost straight away. Manipulating the lows, creating liquidity within this range. You can see the zone of quote-unquote support that's being created and how we are manipulating the support and reversing, manipulating the support, and through this move to the upside, this is where the reaccumulation got a little bit more confirmed. So again, understand that it would have been over here that we would have been able to see that, okay, yes, the reaccumulation has actually gotten a little bit more confirmed now. Potentially from a distribution, we have moved into a reaccumulation, or potentially we've identified the wrong range as a distribution, and this is a reaccumulation. In a lot of the reaccumulation schematics, you can see the term creek. Now, creek by definition is a line connecting the high points of that range. So if I go ahead and just put a line over here and, connect the high points of this range, that's what you can call your creek. And once the market moves outside or above that creek, that's what we would call the jump across the creek, in a way confirming the accumulation. Instead of me looking at that in terms of creek, I would be just looking at that in terms of a break of structure. So instead of us needing to draw a line over here, what we can do is we can identify internal structure points, lower time frame accumulations and distributions, and simply taking trades based on those. Creek is just another way of looking at break of structure. So this is now the more complete reaccumulation markup from the buyer's climax to shakeout, automatic rally back up, and from that automatic rally you can see even signs of a bearish trend being created, but it ended up manipulating the lows, reversing and breaking internal structure points to the upside. So Up until here, we wouldn't still be extremely clear that this most definitely is a reaccumulation scenario. We can actually take the risk and enter based on other confirmations, which I will speak about a little bit later on. But if we want to be a little bit more careful with the trade, this is where we would have an idea that we can potentially be looking at this as a reaccumulation, but we want to see further confirmations. And it's what happens after, in my personal opinion, that would further confirm this reaccumulation. Remember what we spoke about, constant manipulation of the lows, whether that be in terms of support or a trend line. And what took place after is indeed a beautiful confirmation that yes, we are looking at a reaccumulation range rather than a distribution, because now this is an internal accumulation taking place within the same range, a lower time frame accumulation. This should be a lot easier and a lot more visible to see on the 15-minute time frame, but even here you can identify this as your selling climax, automatic reaction, secondary test, sign of strength. That's not really on the schematics, but that's our sign of strength to the upside, following the secondary test in phase B and the spring. And following that spring, we started to challenge multiple structure points to the upside, pulling back to mitigate some institutional candles on the higher time frames. And once we started to trend, then it's obvious that yes, we are looking at a reaccumulation range rather than a distribution range. And you can even see within this smaller time frame accumulation, the manipulation of the lows is something that is constant. You can see clear manipulation of these lows. And even later on, you can actually see how we have created this trend line. Let me delete all of this and draw the trend line again. You can even see how we've created this trend line and manipulated the trend line and moving higher after that. So there are many different points that you will be able to see manipulation of the lows if it is going to be a reaccumulation. It's just about paying close attention to the market, not staying married to your previous directional bias and allowing the market to tell you the story. So this is a nice reaccumulation scenario where we started off as a potential distribution, moving to manipulating the lows, forming, let's say, this creek, spring, break of minor structure points to the upside, creating lower time frame accumulations, which would confirm the previous reaccumulation and continuing to manipulate the previous lows, whether it be in forms of a trend line or equal lows, whether it be over there, or whether it be these equal lows, relative equal lows over here, just constant manipulation of the lows, and you would be able to see the move higher. Now, remember what was mentioned, a reaccumulation in a way has to happen after an accumulation phase, or at least after a markup phase, and that's exactly what we have. We've had a previous accumulation range, a markup phase, a reaccumulation, and the continuation. I want to look at one more scenario for reaccumulation as well. This is going to be GBPUSD, and this time we are going to be looking at it from a perspective of a schematic number 2, where we didn't necessarily get that nice final spring to the downside to completely come lower than the entire range. So I'm just going to put this in replay mode again so we can look at it a little bit easier, and let me zoom into the hourly time frame as well. This is another potential reaccumulation that, again, at the very beginning could have been mistaken by a distribution from the buyer's climax all the way down here to this shakeout, or people would have identified this as the buyer's climax, to this automatic reaction, maybe secondary test over here and the sign of weakness, following this up thrust and maybe waiting for up thrust after distribution to then sell it to the downside. I'm going to put a pause on this potential distribution and actually come back to it in a couple minutes. But from a reaccumulation perspective, you can see that we have the buyer's climax all the way down to that shakeout. So in a way, that move to the downside from the buyer's climax to the shakeout, and then seeing the automatic rally back up, again, looks like a distribution. So that's that beginner phase that looks like a distribution. Following that, instead of constantly manipulating the low of the range, we started to form another lower time frame accumulation within the same range, and you were able to see elements of manipulation of the lows within this range. Whether, again, you're looking at it in terms of a trend line, or whether you're looking at it in terms of, let's say, more internal liquidity being created over here, where we have equal lows, manipulating the equal lows, and then moving higher. More than necessarily looking at it in this specific scenario in terms of manipulation of the lows, it was the smaller time frame accumulation within the same range that would make the entire reaccumulation more confirmed and more valid. I don't think I need to necessarily mark up this accumulation. I hope by now you can all identify them a little bit easier, but if I want to, this will be your seller's climax to sign of strength. This is areas of secondary tests in the market, following a secondary test in phase B or spring, however you want to label it. In this case, it doesn't don't really matter, and breaks of minor structure to the upside or major structure points to the upside that got broken through this rally higher. So again, understand that in the reaccumulation range, in this range, we wouldn't be necessarily looking to snipe it down here. We would want to see confirmation that this is a reaccumulation. We have moved away from that zone, and this is indeed a lower time frame valid accumulation, and then we'll look for pullbacks to enter the trade. Funnily enough, once we started to move higher from that level, when we ended up coming back into the same levels, you were able to also see constant manipulation of the lows before we started to see a rally higher. How we are reaching below, even if it's a few pips, reaching below the previous lows and then reversing and going higher. I mentioned I'm going to look at this from a distribution perspective as well. So let me go ahead and get rid of these, and then we can have a look at this from a distribution perspective. So let's say bias climax to the sign of weakness, up thrust. And even if you did identify this as the upthrust after distribution, you can see that the break of structure that we had to the downside wasn't a major break of structure. These are minor structure points, and that wasn't the best looking break of structure. We very barely reached below that zone. I would want to see a little bit more defined break of structure. So even if you were looking at that as a potential distribution, you shouldn't have necessarily taken the trade once we created that let's say upthrust after distribution. You would have still waited for confirmation of bearish structure, and then once you started to see this move higher, then obviously you would have stopped taking any sell positions. This was also a very nice scenario for reaccumulation. We did have a good, I'm going to calculate it from here, from the top of that range, a good, 200-300 pip move away from that reaccumulation, which is nice to see. But this is, as I mentioned, an example of the schematic number 2. Where we didn't necessarily get that final spring to manipulate the low of the entire range. We're going to now speak very briefly about redistribution, and the reason I'm not going to speak too much about redistribution is because if you understand reaccumulation, if you can just take reaccumulation and study it in great depth and understand it, then all you got to do for you to practice redistribution is come back to your chart. If you're trading on TradingView, you can click down here right above where it says auto and click on invert scale, and it will literally flip your entire chart. And the reaccumulation that we were looking at for EURUSD is now an example of a redistribution. So as long as you understand reaccumulation, you also understand redistribution. I also have another video on redistribution where you can find it under the WYCKOFF introduction playlist on this channel. So I would encourage you to go and watch that if you want more information about redistribution. But let's speak about one major schematic for redistribution. Again, there are multiple different schematics for redistribution. However, this is the schematic that's most commonly seen, and also this is the schematic that's most commonly traded. So imagine everything I talked about in terms of reaccumulation, but now we're going to apply that to redistribution. So you can imagine, for this to be a redistribution, we need to see the markdown phase, or at least another distribution at the top of that range before we moved lower. And the same way in reaccumulation, the first half looks like a distribution. Within a redistribution, the first half will look like an accumulation, where people would identify this again as a preliminary support, selling climax to the automatic rally or that sign of strength back up. Again, this is the move that in reaccumulation schematics, you can see this as a step-by-step move to the upside, following that secondary test in phase B, maybe expecting a spring before they buy it to the upside, or expecting some major structure break to the upside before they look to buy it. But paying closer attention to the actual market behavior, you will tend to see that within a redistribution scenario, liquidity is being created in the form of equal highs or trend lines or whatever it may be. Liquidity is being taken to the upside, so we are manipulating the highs and moving to the downside. Oftentimes within a redistribution range, you can see that the market will create a smaller bullish trend, and after the final manipulations to the upside, that minor bullish trend will completely break and turn into a bearish trend. This is a little bit more textbook in terms of actual structure points in the market. Characteristics of distribution should also be seen within a redistribution range, meaning oftentimes you will tend to see manipulation of the highs. Oftentimes you will tend to see even lower time frame distributions being formed within the same range to confirm that the larger players are in introducing more supply into the market, the larger players are actually distributing this market again. And it's through these factors that we would be able to distinguish between an accumulation or a redistribution. Where are we manipulating and where are we breaking structure? So more than speaking about redistribution in this picture, I actually want to have a look at it on the actual charts. We're going to have a look at the AUDUSD redistribution example. I'm going to put this in replay mode again just to make it a little bit easier for us to be able to look at it and identify it. And we're going to have a look at this on the hourly time frame. We're going to look at this the same way we did for the reaccumulation. How in this case, even at the very beginning, you can see that maybe as your preliminary support, seller's climax to this automatic rally back up or this sign of strength, the secondary test in phase B. And in this case, this accumulation looks much nicer because we even got clear breaks of structure to the upside and this market moving higher and higher, where it most definitely would have enticed a lot of people to look to buy into AUDUSD. However, paying close attention to what started to take place after within this range would have given it away that even if the larger players were looking at a potential accumulation at that range, they have probably changed their minds and they're probably looking at distribution. So again, it's very important to not be married to any directional bias and allowing the market to tell you what it's going to do rather than you expecting the market to go higher just because you have identified an accumulation. It's such an egotistical thing to tell the markets what you expect to do. Hey, it's an accumulation, therefore it definitely is going to go higher. That means nothing. You have to go based on what you see. And in this specific picture, you can see the markups for the redistribution from this selling climax over here, and then we have an automatic rally back up from the selling climax, and that's our automatic rally back up. I just didn't put that automatic rally over there. Or you can even identify this as your automatic rally back up from that seller's climax, and following that automatic rally you get this test in phase B, and following that you tend to see UT or UTAD, your upthrust or upthrust after distribution. This is the giveaway for redistribution. While we are forming that upthrust and upthrust after distribution, you tend to see lower time frame bullish structure that's being broken to the downside and turning into this very textbook bearish structure. And not only that, you would also be able to see smaller scale distributions happening within the same range, which even if it doesn't make you certain that's a redistribution and you should sell it, at least it should make you careful about the initial accumulation. So maybe you just want to take a step out of the market for that specific day. In this case, that's exactly what took place. I've just put this general zone over here as the creek. I'm just going to take it off so we can have a look at the smaller distribution a little bit easier. Both of these pictures are lower time frame distributions that have now taken place within the same range. You can identify this as your preliminary supply, buyer's climax, the sign of weakness, secondary test within the range, upthrust, and upthrust after distribution, proof of distribution, or minor proof in this case of distribution, with that minor break of structure to the downside. Once we started to break below this entire range, that's when the distribution would have been much more confirmed. But not only that, this is the smaller time frame or lower time frame bullish market that was created, and once this distribution was completed forming, that turned into a bearish trend. Very textbook market structure over here. And as if that wasn't enough, from there we moved to create another lower time frame distribution, which we can have a look at that on the 15-minute time frame, where you can see again signs of distribution happening within this range. However you want to identify this, preliminary supply, buyer's climax, the sign of weakness. You can see these as your secondary tests, this as the upthrust, breaks of the minor structure to the downside, a little bit of indecision in the market. I'm going to for now describe this as indecision, but eventually you would have been able to see the confirmation of that distribution through the move to the downside that we had. You might be wondering, okay, if I wanted to wait this long, I would have been missing out on this trade. That's false. We need to get that idea out of our head that we got to trade the schematic whenever we see it there, and then be a little bit more patient with it. So even if you are identifying the, let's say, incorrect schematics, looking at this as a potential accumulation, through your patience, you would have been able to see otherwise after how we created a distribution trading range after that, how we moved from this bullish trend to the bearish trend, and we also created lower time frame distributions. I'm really liking this new trading view update, by the way. Highlighter, yep, I like it. Good job, trading view. But from there on, that would have been the confirmation of the distribution. As I mentioned previously, you could wait until the market breaks out of the range completely, for example over here, and then look for some trades to take over here upon some of the pullback based on some other institutional concepts or based on whatever other concepts that you want to trade. But this is now a textbook example of a redistribution. As I mentioned, I have another video on redistribution, which I will also link in the description down below if you want to know a little bit more for redistribution. But now I want to speak a little bit more about how to tell the difference between an accumulation and redistribution, or between a distribution and a reaccumulation. First point is very obvious. Practice. Get your eyes used to seeing them. Back test them. Forward test them. Spend time analyzing different markets on different time frames. Save your analysis. Come back to it in a few days. Go back to demo account if you're worried. Don't expect these concepts to very quickly elevate your trading game. Put in the necessary time and you will be able to learn these schematics in your own way and apply them to your chart based on your specific set of rules. Now, practice to one side. If you continuously ask yourself where in the market is being manipulated and where are we breaking structure, this should answer majority of your questions, whether it's an accumulation or redistribution, or whether it's a distribution or reaccumulation. Which way are we grabbing liquidity? And after the manipulations, which way are we breaking structure? Remember that I would want to see some type of a break of structure or some type of a proof that moves away from the area of manipulation straight after it manipulates. So the idea behind it is when we manipulate certain highs or lows, I'm going to go back to the EURUSD example in this case. When we are manipulating, let's say, certain highs or certain lows, for example, in this specific scenario, as the market is manipulating these lows, it's in a way tapping into previous zones of demand. All of this down here, which is people's stop losses, or different type of orders being kept in this range in a way, this can actually be looked at as a zone of demand. So if we move away from that level, if we have a decent move away, and if especially that move away is breaking structure, then that is going to confirm that as a zone of demand. So I want to see what happens almost straight after we manipulate. Are we having a major move? Is that proof that that's a zone of demand down there? So is that definitely a manipulation of the lows and then a break of structure? And then I'll go ahead and trade that accordingly. On top of market structure, what I've written there in terms of order flow, this is also another very important thing. Higher time frames need to agree with your bias. So if you are looking at a reaccumulation, there must be some type of a bullish order flow on the higher time frame. We must be moving higher and higher, and there must be some type of an objective for this to move higher. I'll speak about that in the next slide a little bit more, but think to yourself, where is the general order flow? Which way have we been moving? Have we been moving extremely bullish and now all of a sudden you want to identify a distribution and call the top of the market? If that's the case, you have to be more careful. Don't try and go against the major moves. Don't try and go against the major order flow and then be surprised that the trades are going the wrong way. Patience, yet another obvious point, but I scream this in every single video because it's important for traders to know. A lot of traders think they are patient and think they wait enough for the trades and think it's not important. You're either going to develop the patience or scratch your head in a few months thinking about how you lost 15, 20, 50,000 in these markets. So be patient. Get rid of your fear of missing out. If you want to tell the difference between accumulation and distribution, wait. See what is forming, see which way we are manipulating, see lower time frames, accumulation and distributions, if there are any forming in the same range, and see which direction out of that range we will completely move outside of. It's the patience that stops you from taking stupid trades and allows you to have a more clear directional bias. Stop having the fear of missing out. There's always a trade around the corner. In some of the reaccumulation scenarios, in fact, for the AUD-CAD reaccumulation scenario, I think it was AUD-CAD that resulted in something like a 1 to 130 risk to reward ratio. The patience for that was over a month. We had to wait over a month for that specific trade to come to fruition, if I'm not mistaken. But is it worth waiting that long and then catching an extremely high risk to reward ratio? Of course it is. An objective. I thought I was going to speak about this in the next slide. I will elaborate this a little bit more in the next slide. But generally, why do we need to accumulate or distribute? This is what I meant when I was talking about the higher time frame bias, because sometimes I would want to see what type of institutional candles are we trading into on the higher time time frames, and perhaps on the lower time frames then expect to see some type of an accumulation or distribution. Because now I have a higher time frame objective. There's a higher time frame institutional candle, for example. As long as it also agrees with the higher time frame structure, then if I see accumulation or distribution on the lower time frames based on those higher time frame institutional candles, then obviously there is an objective for that specific accumulation or distribution, and the objective is consistent with the higher time frames. The market is always telling you the story from the higher time frames to the lower time frames, so try and read that story. Finally, some more important points to remember. Stop worrying about entries. I have so many people who ask me about where do you enter, where do you enter, where do you enter? It's thirst. That's the best word I can use to describe it, even if it hurts some of you. That is thirst. Stop worrying about entries. First, actually learn the schematics, learn to identify them, be good at identifying the schematics, look at the market, get your eyes used to seeing the schematics, learn the market behavior behind them, get consistent identifying these schematics, and get consistent seeing the market direction in the correct way, then worry about your entries. One of the major purposes of me doing these videos and of this channel in general is to help you think independently when it comes to these concepts. So stop trying to skip ahead, identify the schematics properly, learn about them properly, and if you think that you have put in enough time, then go to the playlist section of this channel, click on the high risk to reward trades and start to look at them one by one, and you will get an idea about how we also would use other concepts for entries. Also remember that we always have to see a validation of accumulation or distribution or reaccumulation or redistribution before we take a trade, which is that break of structure. That's what makes an accumulation or distribution valid. Again, people are extremely confused about what we mean by break of structure. Where is the structure point? For now, especially if it's the beginner stages, if you're looking at WYCKOFF, you can identify your trading range as your structure. And once we start to break outside of that, then boom, you have a break of structure. Simple as that. Don't trade WYCKOFF on its own, which I have mentioned this so many times. You cannot just open a chart and think to yourself, hey, that's a distribution on the 15-minute time frame. I'm going to trade based on it. Will it sometimes play out? Of course, but you always have to see what higher time frames are telling you. Remember what I spoke about the market always tells you a story. You have to see what the higher time frame structure is telling you. What's the higher time frame areas that we've manipulated? Then little by little zoom into the lower time frames, maybe identifying some type of an accumulation or distribution, and once you get a break of structure, then zoom into the lower time frames and try and perfect the trade, and so on and so forth. So don't trade WYCKOFF on its own. Utilize other concepts that we have spoken about in this channel. And finally, patience, both in your learning and in your trade execution. You have to allow time for you to learn these concepts properly, and even more time for you to be able to apply them the correct way. In some of the previous videos, I have spoken about hundreds of hours being invested into these concepts, and I stand by that. Invest at least a couple hundred hours for you to be able to learn properly about all of these different schematics and all of these different concepts. Now, this brings our WYCKOFF introduction series to a conclusion. I was unsure whether or not there's going to be a part 4 to this introductory series, but as of right now, I'm not really looking to record any other video for this specific WYCKOFF introductory series. Maybe later on we'll come back to it with a little bit more advanced WYCKOFF, break some more charts down in terms of WYCKOFF schematics. But as of now, make sure to watch and re-watch these 3 videos. Go back and watch the other concepts that we have posted in this channel. Make sure to visit the playlist in this channel if you want to watch the market behavior case studies or the high risk reward trades. All of these will help you with the application of learning these concepts. And remember to invest hundreds of hours into these concepts for you to understand them more. So I hope you got value from this video. If you did, make sure to press the like button down below and subscribe to the channel if you are new. We have so many people joining our community every single day. So a big shout out to everyone who's supporting the content in this channel. I appreciate and love every single one of you. But with that being said, let's elevate and let's catch some pips.